In the world of investments, there's one name that stands head and shoulders above the rest, Warren Buffett.
Just making monthly investments in a low-cost index fund makes a lot of sense.
Buy an index fund.
And doing it over time and starting early, starting young in life. And nobody's ever followed that and gotten other than a decent result. Nobody.
Known to many as the Oracle of Omaha, Buffett has proven time and again that he has a knack for picking winners. When Buffett took the reins of Berkshire Hathaway in the mid-1960s, it was a struggling textile company. Fast forward to today, it's a multinational conglomerate holding company boasting an impressive average annual return of about 20%. But how did Buffett achieve such phenomenal success? The answer lies in his 6 golden rules of investing. Each rule, a testament to his wisdom and foresight, has played a crucial role in amassing his fortune. Stay tuned as we delve into these 6 rules, unraveling the secrets behind Buffett's success and how you can apply them to your own investment journey. This is your opportunity to learn from the best investor to ever live, Warren Buffett.
I would say investment teaching in this country in general is kind of pathetic. What you really want a course on investing to be is how to value a business. That's what the game is about. If you don't know how to value a business, you don't know how to value a stock. And if you look at what is being taught, I think you see very little of how to value a business. And the rest of it is playing around with numbers or Greek symbols or something of the sort, but it doesn't do you any good. I mean, in the end, you have to decide whether you're going to value a business at $400 million or $600 million or $800 million, and then you compare that with the price. That's what investing is.
Buffett's reputation is not a product of luck or happenstance, but of calculated decisions and steadfast principles. The 6 fundamental rules of investing that have guided Buffett on his path to success. These rules, while seemingly straightforward, carry profound implications for anyone looking to make their mark in the world of investing. They provide a roadmap, a beacon to guide you through the often murky waters of the financial world. So, whether you're a seasoned investor or just getting started, there's something in here for everyone. Starting with rule number 1.
Cash is always a bad investment. I mean, when people said cash is king a year ago, I mean, that's crazy. I mean, cash wasn't producing anything, and it was sure to go down in value over time. On the other hand, you always want to be sure you have enough. I mean,
Buffett has often stated, cash is a bad investment over time, but why does he say so? Well, let's dive into this concept. Imagine you're holding a $100 bill. It's a nice feeling, isn't it? You can buy what you want when you want. Now let's fast forward 5 years. That same $100 bill is still in your pocket. But can it buy the same amount of goods as it could 5 years ago? The answer is usually no, and this is due to a sneaky little thing called inflation. Inflation is the rate at which the general level of prices for goods and services is rising. As inflation increases, every dollar you own buys a smaller percentage of a good or service. Over time, the value of money decreases, meaning the purchasing power of your cash diminishes. Now, let's bring Buffett back into the picture.
no, I'd much rather own a good business than have cash. All you know is that the dollar is going to be worth less 10, 20, 30 years from now. I say worth less, not worthless.
Right.
You want to watch that.
He understands this concept all too well. That's why he prefers productive assets over holding cash. Productive assets like a business or real estate have the potential to increase in value and produce income over time. They're not just sitting idle, they're working for you, making more money. So in essence, Buffett is saying, why let your money lose value sitting in a bank when it could be growing? So as per Buffett, investing is a far better option than hoarding cash. Moving on to rule number 2, Buffett advises always invest in productive assets.
But you buy a farm because you expect a certain amount of corn or soybeans or cotton or whatever it may be to come your way every year. And you decide how much you pay based on how much you think the asset itself will deliver over time.
What does this mean? Well, productive assets are assets that have the ability to generate income. They're the workhorses that can produce a steady stream of revenue over time. Unlike cash that sits idle, productive assets are active, always working to increase your wealth. Buffett, a seasoned investor, has a preference for certain types of productive assets. Businesses, stocks, and real estate are his top picks. Why? Because these assets can consistently generate income. Let's break it down. When you invest in a business, you're buying a piece of a money-making machine. If the business is profitable, it can provide you with a steady stream of dividends or profits. Stocks are another type of productive asset. When you own a stock, you own a piece of a company. If the company is successful, the value of your stock can increase over time. Plus, many companies pay dividends to their shareholders, providing an additional income stream. And then there's real estate. When you own property, you can generate income through rent. Plus, over time, the value of the property itself may increase, leading to capital gains. So you see, these productive assets are like golden geese, consistently laying golden eggs. They're the key to building and growing your wealth over time. Investing in productive assets is the key to wealth generation. Now let's explore rule number 3. Never invest in a business you cannot understand. A powerful reminder from Buffett to stay within your circle of competence.
Defining your circle of competence is the most important aspect of investing. It's not how important, how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important.
Now, what does this circle of competence mean? Picture a circle. Within this circle lies everything you know, your knowledge, your skills, your understanding. This is your circle of competence. It's the area where you can make informed decisions because you have a deep understanding of the subject matter. Outside of this circle, that's where uncertainty and guesswork creep in. The circle of competence isn't static, though. It can expand with experience and learning. But here's the catch. It's not about the size of the circle, but knowing its boundaries. That's where Buffett's wisdom comes in. Investing within your circle of competence means putting your money in businesses that you understand. It means knowing the ins and outs, the risks and rewards, the challenges and opportunities. It's about understanding the industry, the market, the competition, and the business model. When you invest within your circle of competence, you're not gambling, you're making informed decisions. This rule is a guard against the all-too-human tendency to venture into unknown territories, lured by the promise of quick profits. But remember, investing isn't a game of luck. It's a game of skill, knowledge, and understanding. Understanding what you invest in is crucial. Now on to rule number 4.
I look at the business first and try and figure out what it's worth, because if I look at the price first, I'll get influenced by that. So I look at the company first. I try to value it, and then I look at the price, and if the price is way less than what I've just valued it at, I'm going to buy it.
Buffett emphasizes it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Let's unpack this. Buffett's wisdom underscores the critical importance of evaluating a company thoroughly before investing. This isn't about a quick glance at the stock price or the latest news headline. It's about delving deeper, examining the fundamentals that underpin the company's operations and its industry position. A key aspect to consider is the company's financial health. This means looking at its balance sheet, income statement, and cash flow statement. Are revenues growing? Are profits steady or increasing? Does the company manage its debt well? These are just a few questions to ponder before you decide to invest. Next, take a hard look at the company's leadership, the quality of management. Does the team have a proven track record? Are they innovative and forward-thinking? Do they have a clear and compelling vision for the company's future? Remember, a company is only as good as the people leading it. Lastly, consider the company's competitive advantage. What sets it apart from its competitors? It could be a unique product, a strong brand, or even a patented technology. This competitive edge, or moat, as Buffett calls it, can help protect the company's market share and profits from rivals. Choosing the right company is half the battle won. Next, rule number 5. Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble.
Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come, because you're not going to get 500 great opportunities.
A classic Buffett encouragement to seize opportunities. In the world of investing, opportunities don't knock on your door every day. But when they do, are you prepared to pounce? This is the essence of Warren Buffett's 5th rule of investing. Play big and don't waste opportunity. Buffett is a firm believer that when a viable investment opportunity presents itself, it's not the time to be timid. It's the moment to step up, to be bold, to play big. It's about recognizing the rarity of these moments and capitalizing on them. Buffett's investment strategy is not about making numerous small, risky bets. Instead, it's about patiently waiting for that one big opportunity, and when it arrives, investing significantly. It's about understanding the market, analyzing the potential, and making a calculated move. This rule is a testament to Buffett's philosophy of value investing. It's about finding underappreciated assets and investing big in them, not just sprinkling a few dollars here and there. Remember, Buffett's success didn't come from small, scattered investments. It came from significant investments in high-quality companies during moments of market pessimism. However, it's crucial to understand that playing big doesn't mean being reckless. It means being confident in your analysis, understanding the risk, and making a calculated decision. So, when a golden opportunity arises, make the most of it. Now let's look at rule number 6. Buffett wisely advises, the most important investment you can make is in yourself.
By far the best investment you can make is in yourself. For example, communication skills. I tell the students that come that they're going to graduate schools and business, and they're learning all these complicated formulas and all that. If they just learn to communicate better, both in writing and in person, they increase their value at least 50%. It's just hugely important. And if you invest in yourself, nobody can take it away from you.
Now, what does this mean? It's quite simple. We're talking about self-improvement, continuous learning, and personal growth. You see, the world of investing is ever-changing, with new trends, technologies, and tactics emerging every day. To stay ahead of the curve, it's crucial to keep learning and growing. By investing in yourself, you're not just buying a book or taking a course. You're taking a step towards better decision-making, enhanced skills, and improved confidence. You're cultivating a mindset that's open to new ideas, adaptable to change, and resilient in the face of adversity. Warren Buffett himself is a voracious reader and lifelong learner. He knows that the more he learns, the more he earns. So take a page out of Buffett's book. Read widely and deeply. Attend seminars and workshops. Learn from the experts. Challenge your assumptions. Expand your horizons. Remember, the world of investing isn't just about numbers and charts. It's also about psychology, philosophy, and human behavior. The more you understand about these things, the better investor you'll become. And it's not just about becoming a better investor, it's about becoming a better person. When you invest in yourself, you're not just enhancing your investing skills, you're enhancing your life skills. Remember, you are your biggest asset. Invest in yourself. As we conclude this journey through Warren Buffett's investment wisdom, remember that these rules are not quick fixes. They are principles for long-term success. They are the golden keys to the treasure chest of successful investing. Cash, while important, cannot grow on its own. It needs the fertile soil of productive assets. However, investing in these assets requires knowledge, understanding, and a good amount of self-awareness. The circle of competence is not just a boundary, it's your fortress. It's where you make your stand and evaluate opportunities with a discerning eye. Playing big isn't about reckless betting, it's about seizing opportunities when they align with your understanding. And above all, investing in yourself, improving your skills and knowledge, is the most profitable investment you can make. If you found this video helpful, like and share it with others who could benefit. And don't forget to subscribe for more investment wisdom. Remember, the journey to financial success is a marathon, not a sprint.